It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. It's all about managing your financial future, and that's what we're doing again. Thanks for joining us. Happy to have everybody back. I'm Johnny Dean. I'm your podcast host. Not an advisor here, but boy, have I got not just one, but I've got two. I'll welcome my regular advisor, Professor Rick Plum, back. Yes. Hello. Nice to have you here. And we've got a repeat performance here. Jonathan Savona was so good a number of episodes ago that I've asked Jonathan to come back, as are you, Professor Plum.
Right, we're both CFPs.
CFP professional. I'm still not sure how to say it. Jonathan, welcome back to the show.
Thank you.
Your expertise, if I can call it that, is of course financial planning, and sometimes it takes a little bit more persuasion for people to come on the show because you guys just like working behind the scenes. You love sitting behind a desk one-on-one with with clients and doing all that kind of thing. So I more than appreciate you taking the time to come in and actually speak. We locked the doors. See,
I can't leave.
Jonathan Savona walked into our studio and said, "Hey, how's it going?" I said, "Great, sit down. We're going to have you on."
You're on air.
That's right.
Glad to be here.
Anyway, thank you for being here. I wanted to get into aspects of financial planning. We try to get the perspectives of not just Professor Plum, but of other advisors as well. And I think, as I said that last time that you were here, it was another reason to have you on. Besides that, you were really entertaining, and that's a big part of the deal. So I want to get into this thing, what we call, I guess it's a comprehensive financial plan or integrated financial plan.
Good word.
Do I have that terminology correct?
Yeah,
Jonathan?
I think that justifies what we do.
Yeah. There are so many different elements of putting together that an advisor would use to put together a financial plan. But I think if we were going to narrow it down to certain areas, 3, 4, 5, 6 areas, and we found this online. I'm sure this is available in other areas, other websites. This is from Financial Legacy Advisors, if I can give proper credit. But I'm sure you can find this everywhere. I want to discuss with you, Jonathan, and have you talk about each of these just a little bit. When you're putting together a financial plan, there are basic building blocks to a plan. Right. And the ones that they list here start with the basic, or the base of the building block is the financial position and risk management. All right, we talk about that. We have the next stage up would be the wealth accumulation stage. Once you've built the financial position and risk management, you have tax planning strategies. You've got then actual retirement planning, followed by estate planning, which is kind of at the top.
Right.
Here. If you want to picture a pyramid, you can do that. I don't like the word pyramid, but
no, that's a dirty word.
It really is. It really is. But that's kind of what it looks like. So if I can have you guys talk a little bit about this, because both you and Professor Rick Plum, you guys put together plans all the time. I mean, like, this is what you do, and I want for our listeners to understand how an advisor may do this for them if they've never actually had an advisor, or if they do have an advisor, if they do work with an advisor, kind of familiarize them with this. So let's start, first of all, with the bottom portion of this financial plan. When we talk about somebody's financial position, talk a little bit about that. What do you do when somebody walks into your office?
Well, I think Rick would agree that being prepared makes you more able to withstand what life can bring. And so, as today I came on the show, I thought, what better way than to just reorient ourselves to the different areas of a financial plan? The markets are topsy-turvy right now. Interest rates are rising. We're September 2022. So we need to go back to the building blocks. Do we have everything in place? And we meet people in different areas of life. They could be young, they could be older, retirees. I shouldn't say older. They're retirees. They're, advanced in their planning. Mm-hmm. And so we try to figure out, where are you today? and what might be able to be a benefit as we talk through their position and their risk management. So we start there. Do you have the proper stance?
So in other words, what have you got and where would you like to be, kind of a thing? I mean,
most people come in and they have goals in mind, and sure, we can talk about the goals, but how to get to that goal, we got to know where we're starting from before we can make a plan of, well, we want to get to X, but where are we on the way to there? So whether you're a 20-year-old and you have nothing, including no debt, no anything, or you're in your 40s, you've got kids that you have to worry about, you've got college planning that's in the way, you've got what are you doing right now? What do you have in place right now? Where are you starting from? Because we have to know where we're starting from so that we can create that roadmap to get you to where you want to go. And unfortunately, sometimes the map isn't very clear. But other places, the map can be shown
so
pretty
what would
well.
be
But
an
we got to
example?
know where we're starting.
Well, we start with, where are your cash reserves? What is put away? What is put away for a rainy day, for higher expenses, for whatever you might need when life happens and you need margin? Where are we at there?
So in other words, do you have a 401k plan at work? Do you have a savings account?
What's in the bank? Yeah. What's in cash?
And what's stopping you from doing it? If you don't have, what would be considered normal for your age in the 401k and IRAs and things like, what's stopping you? What's in the way? Are you having problems with debt? Are you spending money in areas that maybe you don't have a choice on, but we've got to figure out a way to handle that?
Yeah.
We've got to find out where you are today and what is happening in your life that is keeping you from getting your goal, because otherwise you got nowhere to start. You got to start somewhere.
Right.
And starting where you're at is what's up.
Finance is personal to a lot of people.
Very.
And when somebody comes in, do they ever kind of hem and haw and say, well, I mean, I could do better. I'm not sure. I'm kind of embarrassed that, maybe I'm in my 40s and I honestly don't have much in the way of a 401k. I mean, I got to think for some people that could even prevent them from coming in at all.
That does.
Right.
Because
you hear that a lot.
They're afraid,
Yeah.
They don't want the advisor to say, "What do you mean? You're 45 years old. You don't have anything at all." That's not the kind. That's not something people need to be concerned about.
No, we want to encourage that there are things going well, and we need to capitalize on those. And there might be things that we can tweak moving forward. So we start with your current position, and that includes debt management as well.
Oh, very much.
There's good debt, there's bad debt, and getting into the specifics there. It makes sense to look at that because I think at times people are confused when there's good debt. What's bad debt? Should I pay the mortgage off faster? Should I not? Should I borrow from the 401k to do this? What should I do with the student loan? So that's a big piece of a financial plan. Once we have that set, that feeds into your cash flow as well. If you have that set, then you might be able to redirect some cash flow to a better performing longer term source, such as retirement savings. But we got to figure out what should be paid off faster, what doesn't need to be paid off.
So you'll look at do you have a mortgage? How much do you owe on the mortgage? Do you have car payments? How much do you have on those? Are there a lot of credit cards that you may be?
I think it was Jonathan I was talking to a couple of years ago about somebody who came in. They had some debt. They had credit card debt, mortgage debt, and they were adamant about paying off their mortgage. They wanted that mortgage gone. The mortgage was at the time maybe 4%. It was before the really low numbers. But so they were taking all their extra money and putting it towards the mortgage. But they had this $20,000 of credit card debt that was sitting out there at 19, 20%. And they were just paying the minimums on that.
It's a good example.
It's like, wait a minute, yes, it's admirable to want to pay off your mortgage, but from a financial standpoint, you'd be better off and have a better financial move. Like, let's get rid of this expensive stuff.
Okay, and that's part of the planning process.
And so there was a little re-education there.
And as you're trying to figure, so this is part of the financial position that you're establishing with somebody.
Sure.
What do you have in the bank, as you said?
Yep.
What are your debts? So you've got assets and liabilities.
What's your income?
In other words.
What are you doing?
Right. Okay. Now, after you've established that, that's kind of the base position here, your financial position. The next step up on this little chart here would be risk management. Now, you might integrate your financial position with risk management together. Is that true?
Yeah, I mean, we're covering the what ifs. What if you lose your job? What if you die? What if you become disabled? By doing the bottom layer, we're covering the what ifs of life. And you've probably heard that many times.
Sure.
If you listen to financial podcasts. But we're looking at life insurance and disability, and if you're there, long-term care, and all types of insurance policies.
What's your employment offer? What might you have to get on your own? What do you have to do
Right.
to make sure that the base foundation is set? Because the risks, people will talk about the risks of investing, but a lot of the problem with investing is the risk of not being able to invest because of a sickness, a disability, or something of that nature. And so we have to make sure we have those covered.
Well, and we want to move on quickly to invest, and
That's the fun
that's
part.
the
Everybody
spicy
wants to move
part
to that.
of financial planning is I want to invest, I want to earn a big rate of return. Well, you might need to protect your family first, just in case. And at least bringing that up and having the conversation is the point.
This is, I guess, why risk management would come before. You talk about risk management before you talk about any of the
Right.
sexy investment potential
Yeah.
or investment opportunities, right?
Sure. It needs to play into the cash flow. Where do I need to cover those needs first in my cash flow?
So is that
where I have
mainly-
extra margin to do something else?
And is that's obviously got to, as you mentioned, insurance, life insurance, I suppose, being one of the top ones. If something happened to the breadwinner or breadwinners of the family, who's going to take care of that kind of thing, I would assume.
Yeah. Life insurance, as families grow, there's many different ways to skin the cat there, permanent life, term life. So we dive into that topic.
Sure. Okay. So you the next part is to see how are your risks covered
Right.
for anything
Exactly.
that might happen.
Right.
So after that, now we've determined where somebody is financially. What do they have in the bank? What are their liabilities? What are their assets? What are their liabilities? And now you've covered what are your risks and how do we take care of risks potentially?
Right.
What is the next step that you might cover with somebody on this?
Well, I think after that, then we can try to put together some goals. Do you have a goal of retiring earlier? Are you saving towards a home purchase? Are you saving towards an auto purchase? There's going to be then that kind of medium term and then long term conversation of where does my cash flow need to end up to meet those goals.
So maybe for the younger person, they might have a goal of just saving for their kids' education or buying a home.
Right.
Where somebody in their maybe 40s and 50s, maybe that's past them or they've covered that and they need to cover for their retirement. So is this age dependent? I would assume.
Definitely. We have many clients come in different phases of life, and sometimes they've covered these things and they're well past the conversation of college planning, and they're moving on to how can I retire?
Yeah.
And other ways, we need to think about college now because we're within 10 years. We can't necessarily avoid it. And so, it's definitely age dependent, life dependent.
And when I look at it, once we've got the risks basically covered and we figured out where we're at there, the next step is now we want to start accumulating some wealth. But what are we accumulating it for? Are we accumulating it for buying a house? Are we accumulating it for helping with education? Are we accumulating for retirement? Are we trying to do all three? Because there are times where I've got this great match at work on my 401k, but I also want to buy a house. Do I put my savings towards the house or in the 401k? I get a big bump with the 401k, but I can't touch it to buy my house. And retirement for that person may be 30 years away, where the house is hopefully, sooner than that. And so but it's all about, we're going to now try to accumulate. We've covered the risks. Now we're trying to accumulate some wealth, and we have to decide what the plans are.
So what you're trying to find out is somebody's more immediate goals and longer term goals. Right. And so how do we finance those? How do we potentially?
Yeah, it's determining what's available. Do they work for a company with a 401k match? Are they self-employed where we need to, bring up different registered accounts, different things you can do? Do we need tax deferral, tax savings, depending on where your tax rate is located?
Is this where you talk about things like where am I going to invest? Is this where we get into things like this, or are we still just trying
When you say where, are you talking about what type of accounts or what type of investments?
Well, I believe it should be what type of accounts, but I think some people are ready at this time to say, what's that great investment that's going to give me the 80% return?
Where am I going to get big return, tax-free, guarantees, all in one?
So
not happening.
Well, no, we're thinking about matching still the time horizon to what we're trying to accomplish. And so if it's still a short-term savings goal, no matter how old you are, you probably can't take the super risky investment. But if it's a long time frame, again, no matter what the goal is, invest in something that has some fluctuation to it. So no, not necessarily yet a specific investment, more an idea of the risk we can take.
But accounts do come into play, going back into what are we saving for? Is it going to be the first time home purchase or a home purchase? Is it the kids' education? And when the kids go to school, how old are you going to be? Retirement's a little bit easier because we know that the retirement accounts are, by the time we retire, most people are going to be old enough to access them. But that the education one comes into play where if you had kids later in life, you may be able to use some retirement plans to help you save for education because you'll be 55, 58 by the time they go to school. If you're on the younger side, the kids are going to be well out of school before you get there. Now we can't use those kinds of accounts. So we're looking at the types of accounts when we're looking at those types of issues, as well as then layering in the time horizon for the investments.
Yeah, it's all integrated. We didn't talk about health insurance. That's a big thing as well. And there's HSAs that are out there. And so if you can figure out the cash flow and you can figure out what they have available to them, then maybe the HSA is a great option for them, depending on where. So it's one example of,
health insurance is a big one, especially for people who are retiring a little bit early or what would be considered before 65, before Medicare kicks in.
Right.
How do we? And we see a lot of people trying to manipulate their income so they can stay on the ACA subsidized plans, until they get to Medicare.
Take what's available to
and
you.
So, so they have cash flow. They're trying to create me cash flow. I still want my $7,000, $8,000, $9,000 a month, but it can't be showing up on the tax return. So how do I make my plan work?
So now that you've got the idea, okay, here are you've established with this person their short-term, maybe medium-term, and ultimately long-term goals. You decide maybe so maybe 401k, some Roth potential, maybe. But you've also, I assume at this point, have to layer in the tax side of this, the tax planning strategies, I would assume, only because that's the next step up in this building block, which would be after you've talked about wealth accumulation. Now, what do you do from a tax planning standpoint? Is that the next thing you have to consider?
Yeah, I think it's tax minimization, maybe management. One of those words we can use because, again, life can change so quickly. You have kids, you have credits, you have two working spouses, maybe just one, and you have different tax brackets you're working within. And so the Roth IRA might be a good idea one year. The next year, the pre-tax might be a good idea. And as the environment changes, we had massive gains last year in the stock market. And if you were investing personally, you had lots of gains. This year, not so much. That's kind of flipped on its,
so far,
the other side. But there's management to be done on both sides if you pay attention to it. And I think that's what we want to do with clients is have the conversation, pay attention to what's going on right now, and try to talk taxes as we go. Taxes is always involved.
But what do you tell somebody? Taxes are very difficult for many people to understand. How do you, on this particular part of a financial plan, how do you approach taxes with somebody that is really kind of sees taxes as something a little too complicated?
I think we want to be careful not to assume too much well into the future, assuming that we know what's going to happen 10 years from now, 20 years from now.
We don't.
We want to be involved in what are the rules today? What can we take advantage of today? What makes sense to do today? And again, one is just if we jump tax brackets, it might make sense to start deferring taxes. We know that today. We don't know what the tax rates are going to look like in retirement, but we also might want to think ahead because we know Social Security can be more taxable the higher your income will be. So we want to have some diversification in taxes there as well. So, that's what we're trying to do is what is today, what makes sense without guessing too much and getting it wrong, down the line.
Sure. You want to help them with taxes today, but sometimes, and what Rick and I have talked about this, sometimes the actions you take today are going to affect you 10 years from now, even if you don't know what the brackets or the laws are going to be, but it's going to affect you 10 years from now. So I would guess that you have to very carefully balance this stuff. Is that correct?
Yeah, one of the ideas is Roth conversions. Market's down. It could be a good idea to convert and invest in equities while the market's potentially down here. So that's one thing we've been doing. Tax loss harvesting is one of those things.
Tax loss harvesting is going to be a big one for this particular year, given the fun times we're having with the market, shall we say?
Yeah.
Do you find that the tax management part of a financial plan is something that people who kind of the want to do it themselves, Is this one that they either tend to gloss over or get wrong? I'm just taking a leap here. Have you seen that? Have you guys seen that?
I've seen it where people think they have a good understanding of taxes. And to be honest, taxes are confusing as all heck for most people. And there's a terminology. You know, you've got gross income, you got adjusted gross income. Neither one of them mean your total income. You've got, deductions, the standard, and then you go to the brackets, and the brackets say the tax bracket ends here, but you have to know that that's taxable income, not gross income, and how these all interrelate to each other. It can be confusing for somebody who has not done it a lot or hasn't done much of it at all. And so it is a different language, so to speak. And it's sometimes difficult.
Well, and unfortunately, not always will tax preparers try to plan in advance on some of these topics.
A lot
as well.
of tax preparers are not tax planners.
Right.
Tax preparers are the people you go to in February, March, April, and say, "Here's all my tax documentation.
Plug the numbers
put it into the return." And at that point, there's no planning to be done from last year.
In fairness, that's not necessarily their job.
You're right.
But it's our job to keep it in mind because, again, it's all integrated with a successful plan as you move forward.
Yeah, tax planning is being done along the way during the year because once the year ends, other than if you're eligible to do a deductible traditional IRA, there's very little tax planning to be done after the tax year ends. And that's when the tax preparer gets all the information. So they don't have a choice. So tax planning, you're either meeting with your tax preparer ahead of time, doing a projection to find out what your income looks like, or meeting with a financial planner or something and saying, what does my tax bill potentially look like this year? And do I have any room to either make a change to either bring my tax bracket down or, in some cases like with a Roth conversion, use up some of a beneficial tax bracket that I still have available to me?
Mm-hmm.
Well, and see, personally, this is Jonathan and Rick, this is where I personally see the real value of an advisor. I look at taxes as some kind of stealth thing that happens. You start running through the fields and you start, jumping around, making these moves, and everything seems great. But underneath the tax bill or potential tax bill, you won't see it until it's too late.
Right.
So I think knowing what money moves you make now, how that will affect your taxes is a very important part. And planners like you guys who understand this, I believe this is where they add value. Can I get an agreement from the guy who does a lot of this stuff?
Definitely, especially in retirement, because
absolutely,
clients don't understand, people don't understand how Social Security is taxed, and it's very hard to even describe the calculation of how it's taxed, and that's just one part of the return that can change each and every year, and especially then as you look at Medicare and how your costs can change. So it's definitely a critical part.
Well, and it's hard for
planning.
People that don't do planning, even preparers. Jonathan and I were doing a speech with tax preparers a couple years back, and there were 35 people in the room or so. They were preparers. They weren't necessarily planners. And we asked, can anybody here give us a good explanation of how Social Security is taxed? And 2 said, well, we have a decent idea, but most of the people just take the information, put it in the computer, and the computer spits out a return. And so even tax preparers, they know how to do the preparation of the return, but they may or may not know the interaction between this kind of income affecting that kind of tax bracket affecting what's going on else.
Well,
on the
as you
return.
said, Jonathan, it's not their area of expertise, and you wouldn't expect that. And I think that's what an advisor should do. Now, as we move from tax planning strategies, the next part of the financial plan, the last 2, the next one is retirement planning. Now, once you've set somebody's tax strategies up, I would think that based on their age, you're going to get into the retirement planning part of the plan. I mean, when people hire an advisor, are they doing this for retirement planning? Or if they're younger, maybe they don't care as much.
I mean, they have retirement plans, and so they're going to need some advice on which ones to use. But as we move forward and you're in your later years of your career, you need to figure out, can I retire? When can I retire? What am I going to do with my Social Security? And when am I going to turn it on?
Pensions.
How am I going to draw these assets income, really, this is all income. How am I going to draw that income out? And in what way that fits my needs, my lifestyle? And there's different ways of doing that in a retirement plan.
Yeah, when we talk about the retirement planning, we're not just talking about, am I using a 401k, a Roth IRA, traditional IRA? We're talking about, the incomes, what pension option are you going to select? When are you going to do your Social Security? Are you going to try to integrate it with your spouse's Social Security? Those are all important retirement planning decisions, as well as, okay, I'm also going to be saving. Should I be saving into the Roth side of the house, the traditional side of the house? Should I just save personally because I don't have availability for those other areas? How does this plan go together from retirement planning? And it's also then once we have all those types of things, then we start transitioning to, okay, now we can start. Once we've done the risk management, once we've done the idea of the accumulation, we've got X number of dollars to set for. Once we've talked about the retirement plans and all that, now we can talk about the fun stuff,
which is
the investments. What investments should I be using, and how they play into the plan? And that changes too. From a 25-year-old starting off with no money in their 401k to a 55, 65-year-old with $1 million in their 401k. They've got different hopes from the market.
I would think when you get to the retirement planning portion of this, and probably the investment portion, Jonathan, that if you're talking to a 35-year-old, the retirement planning discussion is quite a bit different than somebody who's, say, a 55-year-old. Is that true?
Yeah. I mean, are we solving with a 35-year time horizon, or are we solving for a 10-year time horizon? Makes a big difference. The time value of money makes a big difference there. Yeah.
And time is a good asset when you're trying to save for any particular goal.
Yeah. So we've talked about the basic, which is, what is your financial position? What do you own and what do you owe, I guess, right? What are your assets? What are your liabilities? Just to recap what we've been talking about here. Then you've discussed the risk management portion. Have you got enough life insurance in case something happens? Do you have a plan B? What if somebody gets sick? Do you have enough health insurance? And is everything covered on that? After that, we talk about their goals. Well, do you have medium-term goals? Do you have short-term goals? What are your long-term goals? And this plays into their age. How old are you, and that kind of thing. After you've discussed the wealth accumulation part of this, now, of course, as we said, there are the tax planning. Now, so how do taxes play into all of this? Now we've getting into the last two, which, as I said, were retirement planning, and that's going to depend on, are you 35 or are you 60? And then that discussion changes. Now we work into the fun stuff, as you said. So when you talk about investments, and you said
the taxes are fun to me too, but that's okay.
Yeah, right.
Well, what are we discussing when we talk about actual investments with somebody who's putting together a financial plan? What kind of things do you talk about?
Well, I mean, we want to talk about what it means to be diversified and which vehicles you might use to do that. So again, depending on what is available to them, if they're still in their working career or not. But whether you're talking individual stocks, mutual funds, exchange traded funds, these are all vehicles that can help you meet the goal, but they might not be right for everybody in every circumstance. So we want to talk about which is the one for you to use with your.
So do you, as the advisor, Jonathan, do you say, look, I've looked at everything. We've made all these considerations. Do you then make recommendations as to which particular investments they might consider? Or is this much more of a back and forth kind of a thing?
I mean, at Lucia, we have a process, and we do have a team who does that for our clients. So I think the value for Rick and myself is we can spend time on the planning side of it, and we can allow those professionals, our CFAs of the world, to run the projections and do the research and feel confident in a team atmosphere there.
And they decide when to buy and sell. I mean, Jonathan and I spend all our day talking to people about their goals, about their, the other aspects, everything that we've talked about up to this point. We don't have, a serious amount of time to watch the markets, to, really dig deep into a specific company. What's their balance sheet look like? What's their projected? What's all this stuff?
Shouldn't. How
and that's why we have a team of CFAs and others that manage. We put together the idea of what the investment objective is, and we relay that to the investment team, who then implements that objective.
Which I personally believe is the way to do this. I don't think I want my advisor, who's been putting together this plan, to be the one to say, now let's get into your investments and let's talk about, I've got some great companies that I've researched. I honestly, I've used this analogy before. When you're building a home, You have an architect. The architect puts the plans together and says the room should go here.
Right.
You want bigger rooms. You want a basement. You want a kitchen. And
the
we do
architect
this.
knows the building codes to be able to create
Right.
the plan, the strategy.
Correct. Yes. And so you want a deck. We like this. So, well, here's what we can afford. Here's how you do it. They don't go in and actually hammer all the stuff in.
Right.
They don't tell you what kind of drywall. You have specific people who did not design the building, but they are the ones who go in and actually do the building.
They're following the plan that's been laid out.
Right. And I see that analogy, and correct me if I'm wrong, with financial planners like you, which is you guys are the architects. You've already talked about their goals, where they want to be, how they want to set themselves up. But when it comes to the actual investments to help make all of this happen, you got to leave this to investment professionals. Is that how you look at it?
Yeah, I love that analogy. It's the way we've set our business up. And in the same way, we would work with CPAs who can focus on the details of tax planning, estate planning. We didn't dive too much into that. There are estate attorneys who have that who are estate attorneys for a reason, because it's difficult to wade in those waters. So insurance planners, there are those as well who specialize in those type of policies. So if we can guide towards where you need to go and integrate other professionals, we're definitely going to do that.
So it's kind of a team approach that you guys use. People using their various levels, if I can say expertise, I'm not sure I like that word, but the thing that they specialize in. You mentioned estate planning. Now, this is the top of kind of the last key of this. Do you discuss estate planning? I mean, you're not estate planners. I mean,
no, we cannot do the actual estate plan, but we can discuss it. We can talk to them about how they should be considering. Obviously, I can't give any legal advice. Jonathan's not a lawyer. He can't give any legal advice. But we can help educate people about what's out there and what's available, what happens when things happen. And that's important.
Do you discuss estate planning with everybody, or just maybe...
Where we usually talk about it is when we're asking who your beneficiaries are. It'll come up naturally. You know, do you need a living trust? Do you have wills and powers of attorney? And can you do this on your own? Do you need to have an attorney there asking questions and getting it done for you? Do you have minor children? So that you get into the details, there. But it starts with just basically who are your beneficiaries, and we move in to that territory.
Yeah, when you're opening an account for somebody, it's personal money. Okay, do you have a living trust? You're asking the questions, and then you can talk about, when you ask the question, do you have a living trust that you're going to own this brokerage account in? Have you considered it? What are your goals in that area? So you kind of go off on a peripheral tangent just when you're doing some paperwork.
Well, it's how are we going to transition what's left if I don't spend it all to my heirs? What's the best way to do that? And so we have knowledge in that area. We might not be able to put the paperwork together, but we have some knowledge over the tax law and the rules behind transferring assets to the next generation. So
you might make a recommendation. Hey, you know what? Some kind of living trust would work well for you. You may want to talk to somebody about putting that together.
Sure. Depending on your state, depending on the rules, then...
Yeah, because there's more taxes potentially than just... It used to be that we worried about estate taxes because the state tax limits were fairly low. Now the limit is fairly high before somebody's subject to a federal estate tax. But many states didn't raise their rates like the federal government did. And some states are still, basically in that $1.5 million area.
So your state may charge you some kind of estate tax.
A death tax, an inheritance tax, an estate tax. And depending upon what's going on, there's different probate costs depending upon who's receiving the asset. I know some of the states back east, if a spouse gets it, if it's fairly inexpensive. If children get it, the probate's X%. If somebody non-linear descent gets it, but still related, it's another different cost. If somebody that's not related to you, if I leave it to my best friend or something, the probate cost is just ridiculous. So you got to know how these things work so that you can try to create an efficient... Most of what we're talking about here is trying to find an efficient way to make something happen.
Based on somebody's goals. I mean, you're always working around this. So we've the 6 areas of financial planning. We've covered the basic financial position. What do you have? What do you owe? We've talked about risk management with the client or potential client. You've talked about how they might be able to accumulate their wealth. What sort of taxes are potentially involved, and how do we manage that and try to, over the long term, minimize that? We've talked about retirement planning and what type of investments they may want to consider to get them to their goals. and then we've added kind of the estate planning, if that's kind of where they are in their lives. Before we wrap up, there are people who have some things covered. There are people who don't. I gotta imagine that most people probably don't have every area of this covered, Jonathan. And I mean, I've asked people that I know, and I've said, I have some relatives who are having estate issues at the moment, and I kind of hesitate to ask them, but I say, do you have like do you have like a living trust or whatever?
Mm-hmm.
And the people who don't have one are often very embarrassed to say they don't. What do you tell when you're talking to a client? Is really what my question is. They shouldn't be embarrassed that they're 55 or 60 years old and they still don't have what.
I think that's the point of this whole thing.
Absolutely,
that we're trying to create confidence and organization.
Yeah,
and that's what we do. You don't need to know all these things unless you really love financial planning. You don't do it as a career, but you love to do it. Then sure, you're gonna study it and create your own confidence. But I think we just want to create confidence for clients that it's being covered, and we can help you do that.
Yeah. So even if you're 50 years old and you haven't saved like you should have saved, or like maybe you haven't ideally saved enough, or you haven't contributed to your 401ks, I mean, there are solutions. Is that right?
Mm-hmm. Yeah.
Yeah. I just would hate to think somebody would be afraid to go in to talk to an advisor because they think, well, they're going to laugh at me. They're going to say, what kind of an idiot are you? You haven't even, you know what I'm saying?
Trust me, we've probably seen worse. Don't worry. It's not a judgmental thing. It's a matter of, okay, you're in this position now.
Yeah.
What can we do to help you get out of this position if you're in an area where you don't want to be?
Yeah. And the psychological part of it, I've got to think is part of what you guys do.
A lot of what we do, whether it's in the estate planning, the wealthy community, or just the tax planning, whether it's in the investment planning, behavioral finance, controlling an individual or an investor's behavior so they don't keep doing things that are detrimental to themselves, is a big part of financial planning.
Yeah, so it's not necessarily, I'm going to go to an advisor who's going to give me, 30% rates of return every single year. I got to think that that's not the real purpose of an actual financial advisor. Would you agree?
Planning can get technical, and it is in some cases, but it's also relational, and it's just having, conversations that matter and count. And if it has to be a tough conversation and a tough change, then that's the point of it in the end. So we're not afraid to have those conversations. They're not fun, but that's the point of what we're trying to accomplish is a good relationship, confidence, and good decisions that we can move forward towards.
Absolutely. Jonathan Savona, a certified financial planner, CFP professional. You've worked here for a long, long time. I know you work in tandem with Janine Stripe, who's been on this program before.
And we need her back on.
We're going to have her back on. This is all part of the team approach that they have here at Lucia Capital Group, and I do want to emphasize that. If you want to get in touch with Jonathan or Professor Rick Plum, you can give them a call, 800-644-1150, the number at Lucia Capital Group, 800-644-1150. Also go to luciacap.com. You can get a lot of this information online. You can communicate with the various advisors and with Professor Plum and Jonathan. If you know where to look, you go to luciacap.com, luciacap.com. This particular podcast, we do this every single week, and you can subscribe. Go to Spotify if you haven't done so. Get the podcast downloaded to your device on a regular basis. And don't miss an episode, because you would have missed this brilliant episode with Jonathan Savona and Professor Rick Plum. So make sure that you are a regular listener to this podcast and that you subscribe and you don't miss a single episode. Jonathan, thank you so much.
Thanks, John.
I'll get you back
Love
in with your
here.
clients. I hope you do. I really do appreciate it. If I can impose on you in the future, maybe we can dive into a little bit more specifically some of these things like tax planning strategies that you guys use.
Sounds good.
Retirement planning and all that kind of stuff. I'd love to have you back and talk about that if that's okay with you.
Sounds good, John.
And I promise I won't lock you in next time, all right?
Back to work.
plan
Next
this.
time.
Exactly. For Jonathan Savona and Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider a mutual fund or an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum, Jonathan Savona, and Janine Stripe are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.